Joining us now, Post 9, JPMorgan Private Bank Global Market Strategist Anastasia Amoroso and Principal Global Investor CEO Jim McCaughan. Welcome, guys.
Great to be here.
Good morning. Monday morning, starting off with a 200-point rally in the Dow. Anastasia, I've heard this theory that better U.S. data, punctuated by that jobs report, is just offsetting the potential negative impact for trade. Is that what's going on?
I think it's definitely offsetting it, and also the fact that tariffs went into effect, that was very much an expected development. I think that's why the markets are having a little bit of a relief rally here. So it's hard to say what's going to happen on a day-to-day basis, but I would point out that I don't think we've seen the end of the trade wars and the trade tensions just yet. I think as we progress through the summertime, there's a few other things that are going to be on the horizon, whether it's auto tariff discussions, whether it's the conclusion of the Section 301 investigation. So that's one thing to consider, that even though tech is rallying here, I do still think that that's a place we want to hold, but actually hedge some of the gains that we've made.
So is the market overall underestimating the risk of a trade war?
I would say parts of the market are absolutely underestimating the risk of the trade war. For example, when I took the 10-year yield, it's not really telling me that there's a big risk premium embedded in the 10-year treasuries because they're trading close to their fair value. But when I look at a market like China, for example, that's starting to tell me that we are fully pricing in the trade wars, and the market there is looking more attractive than it has in 2 years based on valuations.
Jim, do you see it the same way? Everyone's talking about that big divergence between Chinese stocks and U.S. stocks, which are still up for the year.
Yeah, exactly. And that's partly because if there is a trade war, it hurts Chinese stocks more than it hurts U.S. stocks. It hurts emerging market stocks more than it hurts U.S. stocks. So U.S. stocks are relatively, even in the trade war, a relative safe haven. But I think what the market's doing is playing two quite large probabilities against each other. Usually you got negative tail risk, it's very marginal. Right now, I think what the market's pricing in is roughly a 30% probability of a full-on trade war, 70% that it leads to compromises, turns out to have been a negotiating stance. I think that is about right. It's very hard to know how to price that, though, because the trade war scenario is probably 20 or 25% off the market, whereas the 70% that things will be okay with strong earnings should see a rising market.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.